Okay, testing 1, 2, 3. Is anybody out there? We will be ready to get this thing going any moment now. Very exciting. I can't believe it is already June 29th. That is 50% of the year gone. What the hell year is this already? 2022. Oh my gosh, that's crazy. So half of 2022 is over. Then it will be 2023, and before you know it, 2025. Oh, now this guy calls me. I've been waiting. Sorry, I'm answering somebody a thing. Webinar. Just a moment, and I will be back with you. Sorry, this came up right when I'm starting the webinar. Of course, I've been waiting for this guy for a whole day to get back to me. Okay. Oh yeah, and I picked up the phone to silence it. It became a huge distraction. Okay, great. Now, ready to go. All right, let's see if we can get the screen going. Da 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 da. Click here. Okay, we'll see how that goes. And then hopefully you guys can see my screen and we'll get this show on the road. Dun, 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 dun. Dun, 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 dun. So where was I? Oh yes. So the second half of the year is over. And then that's it. Then 2022 is on the way downhill. And boy, what a shit year it's been so far. Very, very down for the market. Let's see. Pictures are coming in good. All right, we'll talk about that in a minute then. All right, let's get on the computer doohickey and we'll be ready to go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, representatives, agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Oh, all right, that was quick. Okay, so It's just like getting into relaxing mode there. Where was I? Oh yeah, stuff going on, time, end of the year, end of the world, so on and so forth. Oh yes, there we go. So here we are halfway through the year, and, well, unfortunately, we started the year right at the high. And we ending the year at an incredible low. We're 1,000 S&P points down from where we started the year. So there you go. That's easy to do. That's 1,000 divided by 4,800. And that's 20.8%. That's what they call the bear market when you're down 20%. So, you know, the thing is down 20% from what? Because, you know, a high is an arbitrary thing. And as you know, well, actually, this high is not arbitrary, though, frankly, because the S&P moves in these chunks. So 4,000 would be a baseline for the S&P. So that means 4,800 is 20% over the baseline, and 3,200 is 20% under the baseline. So the range, the long-term range around the 4,000 line for the S&P 500 is in fact 4,800 to 3,200. There's nothing particularly unusual about this. So, you know, in perspective, so freaking what? That's crazy. So that, you know, this is pretty normal. Although I guess really it's a stretch to say 8,000. The S&P truly, the bottom here is 800, okay? Then 1,600 is the next goal. Then 24, then 32. But either way, 32 is going to be the significant support. So whether you count it from 4,000, so 4,000 is the aspirational goal after 32. So because that's how the S&P does its major moves. So 4,000 is significant. Now 4,000 is where we decided the fair value for the S&P should be. But with the war, it's very reasonable that we should trade below the fair value line for the S&P, because that's a problem. You know, I'm thinking that the fair value took into account everything else, taking into account COVID, taking into account the supply chain disruptions, blah, 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 blah. Before the year started, we were very happy saying 4,000 was where the S&P should be. But then the war started in what, like February, March, February. And that obviously is going to take 10% off the market. You can't say that the war doesn't take 10% off the market. It's a freaking disaster. It's a huge disaster in Europe. And that's exacerbating the inflation. Okay, you know, yes, we took inflation into account, but no, we didn't take wartime inflation into account. We didn't take this kind of reaction to energy into account. You know, and this is a thing with because well, here you go. This is where we were in the beginning of the year. We were at $80 oil. Now we're almost at $120 oil. It's 50% more oil. And so much of the inflation that we have right now is all coming from this incredible surge in the price of oil. That, you know, that drives the cost of so much. Obviously, the transportation costs are driving the base costs of so much stuff. 1/3 of an airline fare is transportation cost. So if 1/3 goes up, 50%, then that's 17%. So basically 20% of your additional airline fares are just based on the price of oil popping up. That's, you know, so look at it like that. And that would apply also to the shipping, the trucking fares, and so on and so forth. You know, Amazon, God bless their little hearts, is keeping up their profit margins, even though the cost of oil has gone through the roof. So Amazon is doing what? All right, like, you know, Bueller, anybody, Bueller? It's, you know, Amazon is obviously passing on all the shipping costs to you, the consumer, whether you see it or not. One way or another, they're passing those costs along. So in the So they're passing along in prices. That's why when they say free shipping, that's bullshit. It's not free shipping if the price of shipping goes up and you're covering it, right? It's not free shipping. It just means the shipping is baked into the price. It's not free shipping at all. What it means is if you don't get the free ship, excuse me, if you don't get the free shipping, you're screwed. That's what it means, because the people who are not Amazon Prime customers have all the pleasure of paying the increased shipping costs and paying the increased prices that are being marked up to us, to the idiots who think they have free shipping. And here, let's demonstrate. Now, of course, Amazon is doing their part, and they, of course, are moving their fulfillment centers and being smart about getting their product closer to the customer, so they've got less shipping distance and blah, 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 blah. But this doesn't all happen in 1 quarter or 2 quarters. They didn't improve their efficiency by X% in this amount of time. That's just not a thing. How do I do quarterly? Income statement, quarterly. So here you go. Look, revenue. All right. So well, it doesn't matter. I mean, okay. So March 108, March 116. So revenues are up. Cost of revenue went down. Isn't that interesting, right? Wait, oh no, here, sorry. 108. No, cost of revenue went up. So look, revenue went up. Cost of revenue went up. Or total, I'm sorry, the cost of revenue. Blah. Cost of revenue 66, cost of revenue 62, cost of revenue 66. So it went up pretty proportionally. Profits went up 46 to 49, also proportional, right? Operating profit. Where the hell are we? 8.8 billion. Well, actually, operating profit went down. So net income, blah, blah, blah. Oh, actually, no, I take it back. Okay, poor Amazon, they took a loss here because they did have a much lower operating profit. So I guess they didn't pass along all the costs. I did. See, I'm coming. Oh, here you go, net income. So they didn't pass along all the costs because last year they made $8 billion and this year they lost $3.8 billion. But that's not all shipping costs, but you get the point. But there you go. Okay, so I was wrong about that using Amazon example. I didn't realize they lost so much money last quarter. Why? So no wonder their stock is down. It's a damn good reason their stock is down. But anyway, so some people are passing along their costs and some people are not passing along their costs. But eventually, here's the thing though, eventually everyone passes their costs along. So look, last year, 2021, this quarter, well, we're into June now, but last year in June, they were up at 160, over 160. Now they're barely over 100. That's a hell of a drop. Now let's say, oh, well, they should drop. They're not even making money now. But they will make money. This is the thing, though. Even if they're taking a hit now, they'll eventually, prices will adjust and they will take into account the inflation. They'll move forward. And how do we know this? Because every company on the planet does this. We've had inflation and bouts of inflation for hundreds of years, and most, not all, most companies survive it. Most companies muddle their way through and get back to profitability after a phase of not profitability. But that is no reason, and I'm no fan of Amazon, by the way, but that is no reason to dump on stocks just because they're having inflation issues. People are just super impatient. And honestly, that goes for everybody, because you can't expect every quarter that your portfolio is going to go up. It's perfectly normal to have a retraction and things to go down for a period of time, but we don't sell everything we have just because it goes down. This is why we hedge. Like the long-term portfolio at the moment. Now we added a bunch of new trades, but the long-term portfolio says 205, and that is 1.526. And if I remember correctly, how am I going to find it? Frick. When do we? Oh, well, I was going to say review on it. It's got to be like. Oh, I don't think it was June 14th though. We didn't. That was a short-term portfolio review. Well, that's important too. So the short-term portfolio was 900. Keep this in mind. Okay, so we have 9. That's easy enough. 900 for the short-term portfolio. Oh, I'm not logged in. $900 for the short-term portfolio, and the long-term portfolio was what? We did that on Friday or Thursday. I'm going to go with Thursday. I seem to remember doing it on time. I try not to do it on Friday because then nobody has time to adjust. Oop. LTP. Nope. Damn it. Oh, and the LTV peer review yesterday. That's a good hint. So back a day. Oh, that was pretty good. I did that on Wednesday. I'm impressed. How the hell did I do that on Wednesday? With the webinar and everything? God, that feels amazing. Okay. Oh, here you go, 1.512. So, I mean, this isn't very long ago, but it was June 29th. So it's 2 weeks ago. We were 1.512. Now we're 1.526. So we've gone nowhere. But the short-term portfolio, and I guarantee you, is up significantly. $1.4. So now we're back at 2.9, and the highest we've been is just barely over $3 million. So we're back at a combined $2.9 million. And it's everything's fine. I mean, it's just generally that's what the hedges are supposed to do, right? They're supposed to take care of us when the market moves down. And in the long-term portfolio, we didn't really make too many adjustments. Let's go back to that. We didn't make a lot of adjustments, but what we did, no, you see there's nothing blue here. HBI, we doubled it down. It's very little. Logi, but these were all bullish adjustments. Logitech, we bought back the calls. Philip Morris, we bought back the calls. Pfizer, what do we do? The $40 calls, we roll the calls on Pfizer. Rio, we just pointed out how great they are. And they are great. Rio is like a super buy. Tupperware, we rolled the calls. Yeti, and we bought back the short calls. So we did very, very little other than a couple of cosmetic changes. Buying back the short calls is like a step we take when we feel something is bottoming. So here's Yeti. We buy back the 80 calls. This, by the way, these are weeks. So I think these are weekly. These are weeks. So 2 weeks ago, we called the bottom on Yeti. We bought back the $80 calls. Oh, by the way, this is an important point. When we're reviewing the portfolio, right? One of the reasons we do these monthly reviews is to enforce this disciplined concept on you guys that you don't need to, this is something we used to have a problem back in the day when we had a lot of newbies and stuff. You don't need to constantly adjust your portfolios. So we're effectively picking, it's not arbitrary, but we're picking earnings week to make our adjustments every month. Earnings week is when we make our adjustments. If something drastic happens, we'll make an adjustment. But generally, we wait until earnings weeks to adjust our positions. Why? I'm sorry, not why, because there's no sense in just constantly adjusting every time something happens. There's no sense in staring at every single position and saying, are we there yet? Are we there yet? Are we there yet? Right? Once a month, we look at our positions and decide which ones to adjust. Now, which ones do we end up adjusting? We end up adjusting the ones that are definitely looking bottomy. And I shouldn't say looking. Looking has nothing to do with it. I look at the numbers. You know, when I adjust a position, I'm here. All right, and I'm looking at Yeti. I could really care less what the chart looks like. Stock report. So when I look at Yeti, I'm like, where are we now? 40 bucks. What's 40 bucks? $4 billion. How much money do they make? $300 million. Well, that's pretty cheap then, right? That's like, 12, 13, 14 times book, something like that. What do I think of Yeti? Well, you know, look, they go 639, 779, 900, 1 billion. So it's 10%. This is, oh, don't forget that. Oh, 30% here, another 20% up, you know, here, another 20% projected next year. What? So that's some serious freaking growth. Okay, and we already, obviously, it's in the portfolios. We already know them. We like the company. We like what they're doing. We believe in what they're doing. Are the numbers going up? Sure, 150, 200, 150, 200, that's 30-something% up. 250, another 30-something% up. 300, another third up. Or 20, I'm sorry, it's only 20% at this point, 20% growth at this point. So they're growing their profits 20% a year. And they're only at 3 billion. That's the other thing, is understand the space. They're only at 3.9 billion. It's not a lot. So they're in early stages of establishing themselves as an outdoor sporting gear sort of brand that started off selling thermoses and mugs, and now they sell more stuff, and they'll sell more and more things as time goes by. And they might get into clothing like Canadian Goose. Not that Canadian Goose does outdoor stuff, but you know what I mean. They might get into clothing, they might get into shoes. Who knows what they're going to do? But the bottom line is, good company, well run, growing nicely, and I expect this growth to continue for quite a long time. Therefore, what a great opportunity to get in while they're cheap. While they're trading at 15 times the current earnings, which is going back to here. But really, they're already into this year, into their fiscal 2023. This year's over. It's not estimated. See how this is estimated? It's not estimated 2022. They closed 2022. And look at the, well, I can't point at it. I can't point at it, but look at the net profits. This is lovely. So when we say, let's buy back the short 80 calls, because we sold the short 80 calls, God knows when. Oh, that's not the long-term portfolio. There we go. So we sold the Yeti short 80 calls probably when we bought them back in May. And in May, they were, nope. Where'd that chart go? Oh, I guess I was looking on the other thing. There it is. So in May, we thought they were cheap enough because they were at $50-something. Now they're at $40-something. So when we bought them 20% ago, and we thought that was great, and now it's at 40, and we think that's even greater. So because it's at a level where we want to react, that's why we're making the move. Not that we make moves because it's option expiration week. It's on option expiration week. We are looking at our stocks to see which ones are worth making adjustments. We don't want to make them all. I'm very cognizant of how much money we have in the portfolio to play with, which is 1.2 million at the moment. So you're 1.2 million cash on hand. We've got a $1.5 million total value in the portfolio. So I don't want to go doing crazy stuff. And we didn't want to spend a lot of money making adjustments if we didn't have to, but I know I'm going to roll Yeti. If it goes any lower, I'm certainly going to roll this down. So step one is buying back the short puts we already sold. We bought back the short puts. That leaves us with these calls. Now, the next move is either two things are going to happen going forward. Let's do the chart. And I don't know which. It's not magic. But my decision here at 40 is to step one, buy back the short calls because the short calls were already extremely cheap. I don't know if I said the number here. No, but we can look up and see what it was. Yeti. Short call. Oh, I'm sorry. We started in January. I must have rolled these down already. So in January, we sold these short calls for $12.65. Now they're $3. So they're up 76%. We have to wait until 2024 for these to get to zero. That's 18 months. So if it's only $3 and it's going to take 18 months, I can only make not even 20 cents a month. That's the best we can do, is wait for the decay to chew these things up at 20 cents a month. That's not worth, it's not worth leaving open. So we're better off buying it back. And then if there's a bounce, we're going to resell it. So the two things that are going to happen here is either we're going to bounce and we get to resell calls for a better price. And we did. We already got a 20% bounce here from 40, whatever, from about 40 to about 50. So we already got a 20% bounce. And so that's why it was a smart play. If it had gone this way, it wouldn't be a big loss because we were only going to make about 20 cents next month anyway. We aren't going to make much money leaving it on there, so there's no point to leaving it on there. Opening the slot reminds us that we're in the middle of an adjustment for Yeti, that we need to do something about it. And if we're below 40, we already know we want to stick with it. So I'm certainly going to roll down the $40 calls to the 30s or the 20s, and we'll sell appropriately the whatever it is to pay for it. All right, and how's that going to look? Okay, so Yeti. And again, this is just an example. These are all very similar decisions that we make, and we do them in stages because you don't want to do everything all at once. You want to do it as you can. Maybe it gets cheaper, maybe it gets better. And some trades are worth doing and some trades are not. So we currently have the Yeti 40s, and they're currently, do we have the 40s? Well, they're pretty expensive. What did I do with that thing? Yeti, $40 calls. Okay, wow. Okay, so we have the Yeti $40 calls, and those suckers are where are we? So those things are like 15 bucks. Okay, if we roll to the $30 calls, those are currently 20. Wow, how much are these? Yeah, that makes sense. So these are about 15 and these are about 21. It would cost $6 to roll down. We do not roll down $10 for $6. We don't do that. But if Yeti got lower and the roll got below 5, we will roll down $10 for $5. We'll spend 50% of the cost to roll down in the money. All right, so Yeti was at 40 at the time, so it probably was a little cheaper, but whatever. Then, and the point is, if we roll down to the 30s and it cost us $5, and then we sold the 6750s for $5, we probably would do better. Sold 65s for $5, then we'd be in the 30-65 spread, and we would have spent no money to do the roll, to roll down $10 lower in strike and cover. See how easy that is? So we leave ourselves open, and obviously it's not net because we would spend net 3 because we already bought back the short calls for $3, remember? So we bought back the short calls for $3, but that doesn't matter anymore. And that's something else that's very tricky to teach people to understand. It doesn't matter anymore. That money is already spent. It's already reflected in this amount. So the question is, from what I have now, you can't look at your position, and I know a lot of people obsess over this shit too. You can't look at your position and say, I sunk 18,467 into this position and I got to get 18,000, blah, 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 blah. That's not the point, right? What do you have to work with now? And what I have to work with now is I own these calls. Doesn't even matter what I paid for it. I own these calls. I have these puts. So I have this obligation and I have that asset. What am I going to do with it to make sure I make a lot of money? How much did I spend on this asset, the remaining asset, the cash in my portfolio and the balance in my portfolio? That's already the score. You know, I made money on Yeti. I lost money on Wheaton. I lost money on Vail. I made money on Target, whatever. It doesn't matter. This is where we got to. This is our balance now. This is what we have to work with. How much do I like this position now? And how much do I want to do with this position now? You can't look at every position and say you have to win it. You know, you can't look back and say this position is a loser. It doesn't matter. What matters is whether or not right now it's a good position. So right now, I think I want to. Right now, I believe Yeti is underpriced, probably should be at 20 times. Let's say, okay, here you go. So how much should Yeti be? Yeti should be in a better market. It's going to be 20. It's a growth stock. So it's going to be 20 times 300 in 2024. So within a couple of years, I think the market will calm down. I think the recession will ease off. I think the war might end. Various things can happen that'll let a company like Yeti get back to a 20 times earnings. That would be $6 billion. Currently, they're at $4 billion. Therefore, I believe Yeti will be 50% higher than it is now. It is now 45. So 45 is you know, when you say, where's the company going to be? 45 times 1.5, 67.50. All right, notice I said I'd know 67.50 calls, but that's only because like my instincts are, I'm not going to say I don't do the math in my head. I don't want to say it's like instinctual. It's more like, you know, I see something like that. The math is already floating around in the back of my head, so I know what I'm going to pick. That's only because I've done it 10 billion times. I've had my 10,000 hours of practice doing these things. So anyway, easy enough, right? But within a couple of years, which is my target time frame, I think we can pull 20 times earnings out of these guys, and I'm comfortable saying that we'll be at $6 billion. And that's 65. And now notice, of course, now you can look at the chart and say, well, gee, they were at 80, they were at 100. You know, they weren't making that kind of money. When people were paying $100 for Yeti in not 6 months ago. 6 months ago, people were paying $100 for Yeti, and their earnings at the time were not even $200 million. I'm saying at $300, people are going to pay 65 bucks. I don't think that's crazy. What do people do in a bull market? What is their typical reaction? When's the last time somebody paid 50 bucks for Yeti? Here we go. Okay, in September of 2020 is the last time Yeti was here. In September 2020, don't forget their fiscal, so they were running off of these earnings. So the last time people paid 50 bucks for Yeti, they were making 779 million in revenue, half. They had 57 million in profits, 1/5 the amount of profits, and people were then paying 50 bucks for this company. All right, and what else do I like about Yeti? Yeti is a nerd stock. Nerd stocks are great. Nerd stocks are Tesla's a nerd stock, Bitcoin's a nerd stock, things like that. And what a nerd stock is a stock that's priced under 100. I mean, Tesla's no longer a nerd stock, but it started out that way. A stock that, if you think of the guys on like the Big Bang Theory, right? They've got their fanboys. They go to the comic book store, right? They've got a good amount of disposable income, and you all know people like this. They got a good amount of disposable income, And they'll walk in and they'll see like a Luke Skywalker holding a lightsaber statue made out of plastic, and it's $100, and they don't think 2 seconds about taking $100 out of their pocket and going, here you go, I want that statue, it looks cool, I'm gonna put that on my shelf. All right, and I got stuff like that on my shelf. I love shit like that. It doesn't mean anything to them. All right, those are the same kind of people, and there's millions of those kind of people, millions. Those are the same kind of people who buy stocks that they've heard of, that they like. Not to be investors, but to have the stock. I like Tesla. I'll buy Tesla stock. How much is it? Here's $1,000. I'll put 1,000 into Tesla. I'll put 1,000 into Yeti. I'll put 1,000 into Allbirds, the shoe thing. You know, people like stocks. Now, those people are very powerful, though, because they are buy and hold. They're not traders. They just put it in their portfolio and they leave it. They don't watch their portfolio. Their portfolio doesn't mean anything to them. Right? You ever see anybody on the Big Bang Theory talk about their stock portfolio? But they don't. You know, and again, you know people like this. They aren't sitting there obsessing over their stocks. You say to them, in fact, you have conversations with people like that sometimes. You're like, you have a retirement account, you have this and that. It's like, I got a 401k or something. I got this, and I like Robinhood. I got Robinhood. I got about $50,000 in Robinhood. You know, that's basically how they think about it. They have stocks that are interesting, but they're not trading on Robinhood. They're just putting, when they see something they like, they just constantly put a little bit of money into Robinhood. They see something they like, they buy it, and it goes up and down, and they watch it. You know, and they just like to see if a stock they like is doing good. There's a lot of people like that, and when you have a small company like Yeti, okay, and the shares start out at a certain price, at like, let's say $50 or whatever. So at $50 a share, it's $3.5 billion. Or it's $4 billion. So therefore, this is always good for you to know, right? So if it's $4,000 million, all right, it's $4 billion, do the math properly. $4 billion divided by $50 a share is 80 million shares. All right. So if 8 million people buy $500 worth, it's pretty much gone. It's half of the shares are taken up by fanboys, by people who are going to hold them and aren't going to trade them. It reduces the float significantly, and that means there's a scarce amount of stock to trade, and the stock will tend to go up very quickly and stay up because there are no sellers. So when you have name brand stocks of things that are currently trendy and popular, and this is where Canadian Goose went crazy also, especially things like that, things people wear. Goose. And my daughters do this. This is how my daughters make their investing decisions. And frankly, I taught them that. I mean, I basically told them when they were young, I was like, buy things you know. Buy the stuff you use. It's like you and your friends know what's the next hot company, right? But the trick is they got to understand to sell it when it's no longer hot. But buy the next hot company. If you and your friends are all going to a certain place to eat, if you and your friends are all buying the same clothes, if you're doing the same activities, and you can buy a stock in it, that's a stock. Watch how it goes. Buy your own thing. So here's Canadian Goose. And I don't know how long they went. But yeah, so they're now back at their IPO price, which is interesting. And it's another one, right? Because Canadian Goose, which I wouldn't have touched I wouldn't have touched it at the higher prices. But again, it gets bought up by these people. Then it goes flying higher as more people get interested. They're not selling, though. That's the thing. They just hold on to it. And now it's back to 16. Like, I bought it at 16. Who cares? You know, they're in it for the long, long haul. But look at Canadian Goose. So Canadian Goose IPO'd at 16, so 1666. So they had 400 million in sales and a teeny bit of profit, which is nice. They had some money. They now have 10 times more profit and 5 times more sales, or whatever that number is. Not even 5 times, 3 times more, 3 or 4 times more sales, let's say. They have 4 times more sales and 10 times more profit. Also, nice growth. You know, I mean, like, you can't really blame them for faltering during the thing. So 6, 8. But notice that I didn't have to make an excuse for Yeti. Yeti's banging along no matter what. But these guys they faltered. And again, you're not going, because people weren't going to malls. You're not going to go try out your new jackets and so on and so forth. And they're a little bit more narrow in their focus, these guys. But 6, 8, 950, that's not bad. 9, then 9, they falter. 1.3, 1.45. So they're growing 10% solid per year. Profits solidly expanding along with it. Great freaking company. $200 million in profits. Buy the whole company for $2 billion. 10 times. All right. Debt, we didn't talk about debt, but you know, not much debt. 330 million, debt's fine for a clothing manufacturer. It's another one. In fact, we should remember that. There's somebody remind me to buy this thing because this is too cheap. This is the kind of stuff we look for, though, right? These are the bargains that you couldn't have, that we missed it. You know, we missed our chance to invest in Goose. It went too high. We lost interest in it. And now all of a sudden it's low again. This doesn't count because when this happened, everything was collapsing. We thought the world might end, and we were just happy it didn't end. Right? We were all locked down. There was a deadly virus raging, blah, 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 blah. That's not what's happening now. You know what's happening now? We're all getting back out. The Fed is raising rates. The Fed is not COVID. Okay, the Fed can stop whenever they want to. The Fed will stop. The Fed will not mutate and start charging higher and higher rates. I'm sorry, they will charge higher rates, but they won't start raising rates like 1.8% every quarter or whatever. The Fed will fight inflation. The Fed will do what they have to do. But the bottom line is that they are also going to be conscious of killing the patient. They don't want to kill the patient. It's not the same thing as a virus that stops commerce. They are purposely slowing down the economy for your own good. It's like when they put you into a medical coma so your body can recover. It's not ideal. They say, I'm going to put him into a medical coma. And you say, well, doctor, will he be able to go to the ball game? Will he be able to play in the ball game this week? No, he won't. He'll be in a freaking coma. Okay. Will he be able to go to the gym with me? No, he'll be in a coma. Will he be able to watch TV with me? No, he'll be in a coma. He will not be able to do many things. We're doing it on purpose. We're slowing this guy down on purpose, but not to kill him and not to make him permanently slowed down. It is a temporary measure to help him heal. That is the difference between the Fed and a viral lockdown of the planet Earth. Yet we are treating them as if they are the same thing. Okay? Russia is more like a virus, but on the other hand, they can't do much more than they're doing now. We are already assuming Russian oil will be cut off. We assume there will be no supply. We assume nothing is ending, that nothing is going to change in the future. The oil forward futures are not reflecting any end to the Russian war at this point. It can only really get better. It can't really get worse, other than, of course, a nuclear war breaking out. That would be worse. And that is not likely. And in fact, realistically, all right, short of nuclear war, okay, Putin is playing a game, and that game includes the threat of nuclear war, because he needs to see how far he can push before we react. Because if NATO says, okay, that's enough shit, we're coming in and taking back everything, we're sending troops, and we're taking back Ukraine, and we're building like an Israeli dome defense around Ukraine, and you guys stay the hell out. We're making them a member of NATO. That's the end of the war. That's one way the war ends. That's not the way Putin wants it to end. Putin wants the war to end. Oh, and by the way, they're worried about that because Medvedev, I don't know if he's still prime minister, whatever the hell his position is now, but he used to be the president. He was Putin's puppet president while Putin was supposed to be not president. So that guy just said over the weekend that under no circumstances will Russia give back Crimea. Now, he said it in a way where it sounds like a threat, but that's not a threat. That's a fallback position, isn't it? They already had Crimea. If they would have shut up and just not done anything, they'd still have Crimea. Now he's making a threat saying, you're not going to take Crimea back from us. What? Okay, that's what a guy says when his entire battle plan of taking more territory is falling apart, and now he's worried about losing the territory that they previously gained. All right, well, what did he say? I wish I could spell his name. Medvedev. Whoops. Crimea. Fortunately, Google doesn't need you to know what the hell you're talking about. Ah, there you go. See? So he said any encroachment on Crimea by NATO would amount to a declaration of war, which would lead to World War III. That's an interesting thing to say when you are supposedly taking over the Ukraine, right? Crimea is fallback. So what he's saying now, which is a very, very interesting way, it's effectively diplomacy in a weird way, but he's saying we're reestablishing our claim on Crimea, and we're admitting that we don't actually own the rest. So don't touch Crimea. But they're bowing to the reality. And Finland and Sweden, by the way, Turkey was holding out on Finland and Sweden joining NATO. They're now letting Finland and Sweden move forward and join NATO. Putin is blowing everything. All his goals are falling apart. He was hoping to destabilize NATO, and what he's done is now increase their membership by 2 major countries. Finland and Sweden are not jokes. And so there's 2 big countries, not like frickin' Bulgaria joining NATO. This is Finland and Sweden just joining NATO, very much right on his border. Finland is anyway, very much on their border, more so than anything else that he'd been warning about, where he doesn't want nukes and he doesn't want NATO troops and so on and so forth. Now they're on his back door. So he's just got another 2,000 miles of border to protect, or whatever the hell it is up there. Here, Russia. NATO map. Oh, here you go. Let's see. I love the internet. You say something and there it is. So, I mean, isn't that cool? That I just like having a notion in my head to discuss something, and here's a map for it already. So here you go. This is now the new border. The old border, I don't know what that means, but there was no NATO. Finland wasn't in NATO. So Sweden and Finland are joining NATO now. And now Russia is up here. They've now got this entire border with NATO that they didn't have before. Their old border with NATO was effectively here. Oh, I see what they're saying. Norway was always in NATO, and Norway extends out this way. Norway goes above and around Sweden and Finland. So technically, this is Norway. That's why they had, say, old border like that. And here, but of course, nobody's worried about that. Now this is serious. So now all this is now NATO. All right, and here's Belarus, which is also the lapdog here. And so Russia, you can't move it. So Crimea is over here, and here's Kiev, obviously the middle of Ukraine where fighting is and whatever. So Russia thought they were going to take all this, and they already have Belarus, so they thought they were going this way. Now NATO is going more this way. They're not going to lose Belarus, but basically NATO's pushing here, and Ukraine's going to end up in NATO. I'm pretty positive that's going to happen also. So they've accomplished nothing. They've got none of their goals, and they're worried now that they're going to lose Crimea on top of everything else. That's where we are with the diplomacy there. If NATO committed to this war, Russia can't possibly win. Russia is a bullshit third worldish economy that just happens to have a massive military. You know, they're not what you would call a superpower, not the way we are. They don't have the kind of things that we do. They do have nuclear weapons. So the thing about Russia, though, is that if you beat them up too badly where they have nothing to lose, and you think Putin is enough of a psychopath, he could start nuking things. That's what you call a nuclear deterrent. All right, how did we get on that topic? I don't even know. We were looking at the portfolio. But anyway, point is, I don't know. I really don't know. We were talking about Yeti. I lost track of this so much. We were talking about Yeti and we talked about Canadian Goose, I remember. I don't frickin' know. I don't remember how we got there. Maybe somebody can answer that. Nope, nobody says. Anyway, for whatever reason, we started talking about Ukraine and Russia. But the point is, it's just hard to say what the point is. The point is that we are looking for stocks that fit a profile. And our profile currently is, I don't want to see a lot of debt. Oh, Canadian Goose. I don't remember. Anyway, remind me, please, in member chat that we want to buy Canadian Goose. It's very important. So we're looking for stocks that don't have too much debt. And what is too much debt? Very, very simple. How much money do they make? $200 million. How much money is their debt? $333 million. Every time you see debt, 333 times 0.03 times 3%, $10 million more dollars, okay? Assume every single person is going to get hit by 3% of their debt on the bottom line. And is that or is that not a major impact? Obviously, 10 million out of 200 million, not a major impact. We're not worried. That's what matters. They're obviously servicing this debt now. So what I care about is, have they taken into account the fact that the debts, that interest rates are going to be at least, and we were doing 2% a month ago. We are now doing 3% because based on what the Fed's been saying, we are now assuming that rates are going to be 3% higher than they are now. They're currently 1.75, I guess. I don't even know. But they're about 1.75 now. And we're saying 3% would be 4.75. That should be, at the moment, what we think is going to be the worst case for what the Fed's planning anyway. I will not be surprised if it goes higher than that, because I don't know that 5% inflation, 5% interest is enough to knock the inflation down. But if all goes well, 5%. But the bottom line is now, and I don't know whether or not these projections include higher interest rates, but I'm saying I don't think half the companies have that in there yet. And if they don't have that in there yet, and we'll find out when we hear the earnings for the quarter coming up, but if we assume they don't and we still have a margin of safety, I feel good about it. So we take any amount of net debt, we add 3% to it, and we take it out of earnings, and then we see if we like the company. That's it. Very simple. And obviously this is nothing, but when you look at a lot of other companies that have massive debt, it ain't nothing. Like, okay, like Best Buy, not Best Buy, Bed Bath & Beyond, who had disasters today. Whoops. Best Buy we actually invested in. So Bed Bath & Beyond, $500 million, no profit at all, so screw them right away. But 778 in debt. All right, so 778 in debt. So that's 778 times 0.03. No, 778 times 0.03, 23 million. So now take 23 million out of, even if things go great and they get back, they're not going to get back to that because they don't have the sales for it, right? So let's say proportionally down to 200 million. That's 10%, not 5%. There would be 10% of their best case profits are going to get knocked down by interest right there. But as it stands, it's going to be impacting them going forward. 23 million is a lot of money on negative 93 million. They can actually lose 20% more than they're expecting. Ooh, that's ugly. Look at that net profit, right? Oh, also, by the way, when you see these numbers, you got to know why things are the way they are. New CEO came in 2019. In 2020, he spent a lot of money remodeling stores, revamping stores, also in 2022. So they spent 2 years remodeling, revamping, changing the way the store was. It failed to do anything, didn't generate. You can understand a certain downtick, but this is too drastic. They turned off, well, stores being closed also, but they completely turned off their existing shoppers and didn't get them back, and they're not coming back. I haven't been inside a Bed Bath & Beyond in a while. I would say pre-pandemic. So I don't even know what, what they've really done to change the place, but it always felt very, very cluttered and crowded and annoying to me. And I used to like, I mean, there was a lot of stuff there. Like if you wanted to get house stuff, it was great because there was lots and lots of stuff. They basically just piled everything in. So, you would go to the bathroom area, and there would be like every possible thing you would want in your bathroom was there. But it was all, cheap, basically. It wasn't, they don't have a lot of like high class stuff. They had, I liked a guy who would get silverware there because they had like tons and tons of silverware. So it was a great place if you need silverware, like just go and feel it all and check it out. Used to do that in the Macy's used to be good for that, but not, I don't know, not anymore. They don't seem to have that department anymore. Anyhow, and then, and they got tons of pillows and this and that and whatever, so if you need something and you want to go see a bunch of them, that was a great place to go. But the store became like really yucky and warehousey and didn't have people on the floor, and you just sort of like poking around yourself, hoping to find something. I don't know. To me, it was, and the food thing, I think that was terrible. You walked in and there was like food everywhere, but again, just no particular reason for it. It wasn't like I needed to get that kind of food at Bed Bath & Beyond. I could have gone to a grocery store and gone shopping. So I'm not sure what they were even trying to accomplish there, but I thought that was the weirdest thing. You go into Bed Bath & Beyond and the first thing they have is like a ton of food. It's like a little grocery store there. Of course, you can say the same thing about Walgreens and CVS these days, right? But at least at Walgreens and CVS, it's an afterthought. Like the food's there while you're there. They also have food, but when you walk into the store, you're in where pharmacy stuff is. Whereas in Bed Bath & Beyond, you walk into the store, you have to go through the food to get to the pharmacy, to get to anything that you actually might want. Although I still get my, they're the best place to get coffee. I still order online. I get the Lily coffee pots from Nespresso, and it's so expensive unless you get it from Bed Bath & Beyond. They're like $10 on Amazon and $6 at Bed Bath & Beyond. So I mean per box. So anyway, where were we? Portfolios and other stuff, right? Okay, so yes, what did we add to our portfolio recently? I don't think I got everything added on yet, but conceptually, look for June. Here you go. Oh, Best Buy. So what's the difference between Bed Bath & Beyond, obviously terrible, and take away a B, and it's a completely different company. It's Best Buy. And Best Buy is at $15 billion. Also, though, crashing out, right? Best Buy's at $15 billion. We just picked them up because they're so freaking cheap. They have rising sales, 42, 42, 43, 47, 50, 49, 50. They're not expecting much growth from where they are now. Money, 1.4, 1.5, 1.8, 2.5. This was an accident of sorts. They didn't expect to do this well. They had a big spurt, and they're not projecting it continues. Then $2 billion. So they make $2 billion, and you got to pay $15 billion for the company. Therefore, 7.5 times earnings. That's okay, right? That's pretty good. Do they have a lot of debt? Nope. $545 million in debt is going to be what, $15 million bump taken out of $2 billion. It's inconsequential amount of interest that they're going to have to pay going forward. So that, you know, generally they're in a pretty good shape. They don't have a lot of their big knock is their working capital is down. They're going to have to figure themselves out. They'll probably spin off asset or do something to get some more cash. But I'm nothing I'm too worried about. As long as they're banging along $2 billion, I got no problem with my $15 billion company, right? They can just keep doing that. And all you're doing when you make a purchase like this is you're waiting for them to come back in favor. You're waiting for them to get a 10 times earnings valuation, which is $20 billion, and they go from 67 to 67 times 1.33, I guess is 90. Yep. So they'll go back to 90. And so what's the play that we make? The play we make on Best Buy is we sold the $70 puts, because that's right where they are, right? Well, we sold those a long time ago anyway. We sold the $70 puts a long time ago. We just added, that was our watch. Oh, I'm sorry, we increased this. I think we probably had 5 short before, or 10 short. I think we had 5 short before. Now we made a new spread where we sold 10 more puts, you know, because this is a great price. You know, $13 a put, it's net $57 as an entry, and they're at 66. The spread now notice again, see, I'm very consistent because it's exactly what we calculate. We just went through the calculation. That's exactly the number I picked, right? We did the 60-90 spread, and we only paid $11 for the $30 spread, not even counting the fact that and then we sold the puts. So the net on the spread, we already sold the 5 puts. That was already in the portfolio before we started, but so what? It's not a big obligation, right? So we sold the 5 puts. Now we added this spread. It's 37,000 minus 14,200. That's our new spread. Is a $22,800 we spend on the spread, and it's obviously a $30, right? It's a $60,000 spread. That's in the money. That's, you know, not much in the money. It's $12,000 in the money, but we also sold $19,000 worth of the puts. So minus 19,605 means we only put $3,195 into the spread. And into what? Into a $60,000 spread. 60,000, 30 times 20. It's a $60,000 spread. That's in the money. Well, the puts aren't in the money, but the calls are in the money. So we barely need this thing to move to be profitable. And another portfolio pet peeve of mine, right? We sold the $70 puts. They're at $67, so they're $3 out of the money, the puts. Yet we're being told that these puts are negative $4,000. Whereas if they expire at $67, we pay back $4,500. Yet currently we're being charged $23,000 at this price. So if they flatline from here, we're going to make $18,000 roughly. So there's $18,000 where, you know, and again, that by the way is why the long-term portfolio makes such unbelievable gains sometimes when we have an up market, because, you know, there's things like that. These are ridiculous. It's caused by the very, very high VIX. Where are we? BBY. It's caused by a combination of the high VIX and the low price of the stock. But when you look at the price of the stock, and I say, okay, but that price of the stock is, what do we say it is? 5 times earnings, something like that, 7 times earnings. 15 divided by 2, 7. So that's 7 times earnings. So then it gets back to, like, do I mind owning 1,500 shares of Best Buy at 7 times earnings, Best Buy? Now you could have said this about Radio Shack, right? Where the frick else are you going to go to get this stuff? Okay? Radio Shack died. died, very, very quickly died. So you don't want to get into a trap about that kind of stuff. But, you know, as it stands, if I want a Best Buy, in fact, that's one of the reasons Radio Shack died, though, is all that crap is at Best Buy pretty much now. What you don't have at Best Buy is the really super duper nerds they used to have at Radio Shack who like knew everything about everything. The Best Buy has people, but it's not the same as Radio Shack. Where like you almost always would go to Radio Shack, and you would get a dissertation about whatever little tiny part you needed. But anyhow, but that model doesn't work, does it? So Best Buy instead has an escalation procedure where the floor guys are generally sort of knowledgeable about stuff, but they'll take you over to the Geek Squad desk, and there's a guy in there, you know, which is the old Radio Shack guy, and he'll come out of his cubby hole and tell you what's going on. So they have the person, but they just don't. It's sort of on a much larger scale. They're not supporting, and that's of course why Radio Shack fell apart, though. I mean, you need one of those people per store, whereas Best Buy needs one for a store that services a much larger area. Anyway, so Best Buy still and radio and you know, look, what did Radio Shack do wrong? Radio Shack didn't sell you $3,000 TVs. They didn't sell $50,000 home entertainment units. You know, Radio Shack has a whole super duper profitable little niche inside their store of high-end home theaters. So they get the top 1% is going to go into Best Buy. There are, of course, other places you go when you're that high end, but you know, you can get adequately serviced. Unless you're an audiophile, you're going to get adequately serviced at Best Buy for most of what you want as far as home entertainment stuff. They've got good people, good installers, so on and so forth. Anyway, so by taking that end of the market, which is very, very profitable, it makes everything it pushes everything forward. And also Best Buy very, very intelligently, because they were in big trouble a few years ago when we bought them then too. Best Buy was in trouble a few years ago. They came up with the idea of selling space inside their store to people like Apple and Samsung, who would then have little promotional areas inside their stores. And that's been very successful for them too. It's cut down their rent costs, their cost of footprint, and that's been huge also. So they still got all the stuff. It's still getting sold in the store. They get an employee for free who's an expert in Apple or an expert in Samsung. They have a free employee. They have and they get a percentage of the revenue that comes in there. In fact, they get almost their full percentage. The company does it to promote their products, to make sure their products are getting sold and given adequate attention at the store. So it's really Best Buy's job just to make sure people come and they have traffic, and they do a great job of that. It's always a bustling sort of store. Anyway, so Best Buy is a good thing. Who else do we add recently? These guys. Coinbase. We had short puts on Coinbase. We sold more. Why did it say 620? We only recently sold puts on Coinbase. This is a rolled position that we had them before, or maybe they're in a different portfolio, I forget. And now we took the 35.90 spread, and again, 35 in the money. It's at 50, and we're looking for them to regain some of their old glory. Coin is a more speculative play, but that's our bet on cryptocurrency. I mean, you know, it's a bet on cryptocurrency that I don't think is as risky as cryptocurrency, though it's certainly gotten beat up like cryptocurrency. So, you know, we've been playing coin as it came down, and they're not making money right now. They're estimating a bad year this year. But the thing is that they did make $3.6 billion last year in 2021. They're being valued $11 billion now. And this money reflects well, the crypto market slowed down. They made, I would call it a mistake at this point. They made a mistake of spending quite a lot of money to build an NFT marketplace, and the NFT market that was like that's like building a Beanie Baby marketplace and then going, well, what happened to the Beanie Baby craze? You know, it's like it was a flash in the pan. You know, a pet rock marketplace. There's no point to doing certain things. They jumped right on the NFT thing and started doing that. cryptocurrencies, if they survive, will need a proper exchange, and that's what Coinbase is. That's what Coinbase is. They're a proper exchange for cryptocurrencies. They were doing really well with that. The crypto market crashed and slowed down, so their transactions slowed down. So like any exchange, they're not doing that well. But at the same time as they were massively building the NFT exchange and also revamping the coin exchange to handle a lot more coins, all bad timing. But that doesn't mean there's anything wrong with the actual model. So speculative, but they could easily make so much more money to justify this. If they get back to 3.6 in a few years in 2024, they'll get a 10 times valuation. They'll be at $36 billion. It's 3 times higher than they are now. It's $150 a share. And if they do that, this silly little trade here will be, what is this, 35 to 90 is $55, right? So it's $110,000 spread that we're in for a fairly large net credit on the spread. Because 56 minus 79 is already a credit. It's 23 plus 20. It's a $50,000 credit on the spread. Now, if we're forced to buy the coin, the shares, we'll have $150,000 worth of coin put to us, but less 50,000 credit. So we're only gonna pay $100,000, and that's about the net. This is an aggressive sale, but the net is going to be about 65 bucks a share. That's our net entry on this thing. So it seems like a reasonable risk reward. Crocs, and again, silly, right? I mean, Crocs is at 48. We have a 65.90 spread. Wow, what the hell? Did they drop that much, or did we just have a high spread? Maybe it can't have dropped that much. Oops. Yeah, no. So we just took it out of the money spread because it's cheap. So we took the 65.90 spread. We sold we aggressively sold. Okay. So when we look at the numbers on Crocs, you're going to see some like stunningly stupid numbers, I bet, because that's the only reason I would have done this. Let's see what Crocs looks like. Okay, $3 billion for the company at 48 bucks. What do you get for $3 billion? Well, you get, first of all, you're getting 600 million in earnings, 650, 700. So you're talking about 5 times earnings is how much you buy the whole company for. The company, as we know, Crocs has been around for quite a long time now. It's not like they're a new concept. The company has been banging sales. And I know people have been saying, oh, it's only because of the pandemic that their sales are rocketing like this. I'm like, I'm not sure. I don't really think people are gonna like, yes, the comfortable shoe market probably zoomed up in the pandemic, but I don't think that's gonna go away. I don't think people really go from comfort, like everybody didn't put suits and ties and hats back on once people started wearing casual clothes, right? Casual clothing, comfortable clothing is a thing people do. That's why I actually see whenever you see like a movie about the future, people are like wearing like robes or jogging suits. Like nobody thinks in the future people are going to wear suits and ties. It's not like a lot of people like all dressed up in the future. Except for the Matrix, but that was of course a horrible nightmare of a scenario for people. Those guys all wore suits. Anyway, so conceptually, whether they do better or not, even 2020 is 3 times earnings, but they're banging along. They're breaking into new markets. They happen to be in just a really good position to take advantage to grow during the pandemic because they had cash and they had operating. I mean, Crocs are cheap and profitable to make. They do have a lot of net debt. They got $3 billion in net debt. So that's going to knock $90 million off of earnings. But earnings are spectacular, so we can afford to knock $90 million off of earnings. Is that right? 27, yep. 27, yep, 90. Okay. Yeah. So $90 million we're going to allow to knock off earnings. But even if you knock off $90 million, they're still making $500 to $600 million. And we're still talking about 5 times, 6 times earnings. So my thought on Crocs is they are stupidly cheap, stupidly cheap. Okay, $50 is a price they were at in early 2020 with 1.3 billion in sales and $313 in stock. And see, they spent a lot of money. They spent all this money, went into debt to do this growth. But it's so far it's been working. It's not like they, it's not like they passively sat there and made more money. They've been spending a fortune to expand, and they did it in a look. The company said, "Hey, I can borrow money for zero." These are, they took this money because it was cheap. They're like, "I can borrow money for 2%, 3%." They borrowed the money for 2 or 3%. They said, "If I do this, I'm going to double my sales, and we're going to make plenty of money to pay back the money that we borrowed before the interest rates go up." So far, they're right on schedule. They're doing exactly what they plan to do, exactly the way they plan to do it, but everybody's freaking out. All right, so it's to me, it's a very big opportunity company. Now, we did not overcommit because what if something does go wrong? Well, we committed to owning 2,000 shares of Crocs, which is $130,000, but it's another net credit. So we're not paying more than the actual price here at 65. We don't think Crocs is going to go bankrupt. And if things go badly and they're down at $30 a share, what are we on the hook for? We're on the hook for $36,000. 20 times 18 is going to be $36,000 below what we have the Crocs for. And of course, if that happens, we could then sell more calls, roll, buy more stock, do whatever, and adjust the spread. So do I want to own Crocs at 1/3 off the current price? Yeah, absolutely. So that's my commitment. I'm committing myself to own Crocs at about 1/3 off the current price if things go terribly. But if things go well and they recover the way I think they're going to recover, they should double from here. And if they double from here, 10 times earnings is double from here. If they get back to 10 times earnings, they're going to be a $90 stock. And this spread, I think oh no, this is a huge spread. This is a $25 times that is what, $125,000. Is that right? 25 times 50. 125, yeah, 120 is $125,000 payback on a net zero spread. So my risk is owning $130,000 worth of Crocs. The reward is making $125,000 in profit. If Crocs goes up, we make $125,000. If Crocs goes down, we own $125,000 worth of Crocs stock. That's not a loss. That's just, we have to own it. Delta will probably adjust to make more money too. See, that's the thing. It's like you have to look at each one. So like now I'm looking at Delta and saying, now it's kind of getting interesting to make an adjustment and put a little more into it. It's certainly going to be worth doing a roll on Delta. Disney, another one where we're finally at a point where I feel good about adjusting it again. GLW we recently added, but that's and 35-45 spread. See, and that's the thing, keep that in mind. When we do these spreads initially, we spend very little cash. Okay, we only spend $5,000 cash on this spread, and it's a $50,000 spread. So we spend $5,000 on a $50,000 spread. If everything went perfectly, we'd make $45,000, 900 times what we put into it. That'd be fantastic, but you can't expect that to happen. More likely, it's going to be flatter, or it's not going to go up right away, and then we have to decide, do we want to take the loss, which is currently $4,000 or $5,000, let's say? Do we want to take a $5,000 loss, or do we want to spend some real money now and change it? Do we want to spend, let's say, $5 to roll them down $10 to the $25 calls, and that'd be putting $25,000. So we go from spending $5,000 on the spread to $25,000. So, well, it'd be 30. We spend $25,000 more dollars to roll this lower. But then we've made an investment. So far, we haven't made an investment. These are practically placeholders. When we only spend net $5,000 for the position, it's almost a placeholder. The commitment is that we're going to own the stock at 35, but that's not something terrible. It's at 32. So we're committing to own the stock, but the cash out of our pocket here is nothing. Gold, they're fine. No, not worth adjusting. Haynes, we just adjusted. Hewlett Packard, are they adjustable? No, we're still in the money on Hewlett Packard. Look at that, big profit actually. It was so ridiculously in the money. Our target was only 30. That's funny. Our target was only 30 back like a year ago, and they're still obviously over 30. At one point they were like 50. IBM, never a problem. Wow, look at IBM 140. Intel, ridiculously undervalued also. JD, there's one we picked up recently. And again, see the net, 57 minus 37 is 20, minus 8 is 10,000. So here we put 10,000 into this spread. It's a $50,000 spread. And it's 100% in the money. Oh, that's silly. Okay, sorry. So let's not even worry about that one. JP Morgan we just added, and JP Morgan's at 115. We picked up the 110, 135. And I'm not going to go back and do the financials on everyone, but trust me, JP Morgan is way too cheap. Oh no, it's double entered. Oh, that's weird. Wait, it's not double entered. Oh, we just picked it twice. I didn't realize I already had it. All right, we picked it and we picked it again. Okay, I can live with that. I don't mind having lots of JP Morgan. KHC, Labub, hate them. I now hate them. They just never go anywhere. Levi, we just added, and again, notice the kind of stuff we're adding: Levi's, Crocs, JP Morgan, like basic, you know, never fail kind of companies, things that are going to be around for 100 years. That's what you want to be in this kind of market. And so Levi we added, and that was, here we took a very small spread. 1823 is a $5 spread, although $5 times 50 is $12,500, right? No, it's 25 there. $25,000. Sorry, it's 25,000. How much do we spend on the spread? Well, that's 17,500, 19,700. So about $2,000 we spent on this spread, and it's a $25,000 spread. That's a little below the money. And I'll tell you, Levi. Well, let's look. I don't want to keep doing the same thing, but I mean, it is the same situation, because that's what we've been looking for, right? This kind of situation. Levi's a 666, very satanic, $666 billion company. They make 666. Okay, I got to tell you, that's a sign. I'm sorry. When they make 666 and the value is 666, obviously the PE is 10, right? So, but that's a little weird. If their debt was 666, I think I'd sell it. Their debt is inconsequential debt. Plenty of cash, inconsequential net debt. What more could you want? Why is this stock trading at this price? Well, what is going to happen? Are people not going to buy jeans anymore? What is going to happen to Levi? And you know, they got nice growth. They got 495, 57, 2004. They had a bad year in 2000, lost some money. 57 again, back to 57, 64, 68, back to normal. Boring 5% growth, 10% profit growth, which has come along very nicely. And you know what? Sometimes these are good. Sometimes this kind of stuff is good for companies. Like they could get complacent. A company like Levi's is going to be complacent because they sell the freaking jeans and they do the same thing every year, and everybody wants a certain amount. It's almost like Miracle-Gro. You know, it's like there's a certain amount of lawns and we have a certain market share, and it's going to be what it'll be. So let's just run the company every year and make some money. But then there's a crisis, and suddenly they're forced to rethink a lot of stuff. They say, holy shit, we just lost 20% of our business and we gotta stay profitable. So they go cut costs. Oh, we don't really need this. We don't really need that. We can improve this. We can improve that. And then when the thing turns around, the businesses come out stronger because they've made improvements. That sometimes, you know, old companies can be complacent and then they come out of a crisis in really good shape. So that's that's the kind of that's what happened to Levi over the last few years. But they're in great shape now. Nothing wrong with these guys, and a good purchase. Let's see. So there's Levi. Logitech, I like them because they're such basic stuff again. Facebook, too cheap. We've just added them recently. Although we're doing it's kind of like a butterfly play. We're selling short puts and calls. Moderna, ridiculously underpriced. Supposed to be looking for ones that we just added. Netflix we just added because they finally got too cheap. You know, not that they're not getting cheaper. We're losing money on these guys so far. But again, what did we spend? 166 minus 75 minus 76. We spent net zero, $10,000 on the spread. It's a $200,000 spread we spent $10,000 on. So do I 100% expect that I'm going to make $190,000 with no effort whatsoever? Of course not. But we committed to owning it at 210. And we bought the 150 calls. We're still in the money on the 150 calls. We expect it to get back to 250. And we think that this is not going to be a lasting issue for Netflix. We think it's a great pickup. And why is that? It's a subscription base. And when do we buy it? We bought it down here. Yeah, we did all this on 6/2. So it's not like we did it when it was higher. It's just these are just fluctuations in the prices that are hitting us. So, you know, here's where we did it on 6/2. So we're just about, you know, we thought 200 was going to hold and it went back down. Bottom line though is with Netflix, well, okay. They end up having to look at each one. Well, it's interesting, but I mean, I just, you know, I don't want to take so much time to go through every one. Netflix, $80 billion, makes $4 billion. So, you know, about 20 times, or well, 5 billion. They're calling it 15.7. These are subscriptions. So Netflix got killed because they had low subscriber growth in their recent quarter and everybody started selling them off like crazy. But low subscriber growth means they're stuck at making $5 billion a year with their $80 billion market cap. That's not very high. Okay, so what can Netflix do? You have to remember Netflix has what? 200 million subscribers, let's say, or whatever. So if they raise the price $1 a month, that's $2 billion. So, and as we know, Netflix is currently playing with different models. They're threatening to cut off all the freebie people. They're asking people who do pay, like me, who have daughters in college, to give them an extra buck. You know, they're trying to figure out how to stop like the hundreds of millions of people who use them for free with the passwords to pay something. And if we paid something, if 100 million people pay $10 a year, that's another $1 billion right there. That's all they need is $1 a month from 100 million people, and they're going to make 20% more money. That's how they grow their revenues. They're fairly saturated in the marketplaces, but they have ways to grow their revenues. The other way they're looking at is to have an ad level service for the people who currently are not subscribers. So in other words, make Netflix available to non-subscribers with ads. And they have to decide, though, it's tricky. They have to decide how many of my paying subscribers are going to not pay in order to watch Netflix with ads. All right. HBO has gone through this. It's been done before. HBO has put things on regular shows and let their series be viewed on ad networks and stuff. And they have found that not a lot of people really do that. Paramount does it, of course, with their CBS. People who want to subscribe to ad-free services do not necessarily, you know, are willing to pay a reasonable amount of money to have an ad-free service. You know, and of course, cable obviously is built on that whole concept for how many years now? From 1980. So it's like 40 years of cable TV has taught us this also. People are willing to pay for commercial-free TV. They're willing to pay for better quality TV, for better reception, so on and so forth. So anyway, so I think Netflix's ad base user base is solid enough that they're not going to go backwards from here. So you can expect them to make $5 billion. And if I can expect them to make $5 billion, I can expect eventually their PE to fluctuate back to 20, which would be $100 billion, which would be 25% higher than it is now, which would be 177 plus 25. I'm pretty sure I know the answer. 177 times 1.25, 221. So even if they don't increase their earnings, I still think in a better market, eventually they'll get back to 221, 250 range. We're playing them to hit 250 in 2 years. So a sensible bet, especially when all we did was spend $10,000 on a $200,000 spread. That's in the money. That's currently $50,000 in the money. So that's how we're playing it out. We'll see what happens. But I think that's reasonable. At this point, it seems like a reasonable risk. RH, oh, speaking of kicking ass, right? RH is one of the reasons that Bed Bath & Beyond is dying. They took all the high-end customers, and those are the people who pay the big money for stuff. You know, if I'm buying $1 million house, I don't walk into it and go, I got to go to Bed Bath & Beyond, right? I'm going to go to Residential Hardware and find stuff to decorate it, not probably Bed Bath & Beyond. So Residential, again, ridiculously cheap at this price, and a fantastic growth. This one's so cheap that we left open. We bought 15 calls and only sold 10 puts. So here we're putting more cash in up front. 114 minus 86 is about 30,000. So here we spend $30,000, but it's oh man, that's math. 70, about $100-something thousand spread. So it's $100-something thousand spread. We spend $30,000, but also we're going to sell short calls along the way when it improves in price. Not today, it went down $7. But when it improves in price, we'll sell short calls along the way and make back that $30,000 anyway, knock that down. Here's Rio Tinto, we love them. Starbucks we bought, they finally got cheap, and they've already, well, no, it's still pretty much where we bought them, so still a good price. And again, they're at 80, and the spread we bought was a 65-80 spread. We're only playing them to not go lower. This spread, 16 minus, it's practically zero. I mean, it's been, you know, it's less than 2,000 net, like, it's 750. So 1,000, 10,000, 15,000. Sorry, it's less. It's $1,900. So it's a $1,900 spread net, and 65.80 is going to be $15,000 if it pays off. So all Starbucks has to do is basically not go lower, and $2,000 becomes $15,000 on the spread. That is clearly an initial spread which I intended to put more money into, but it's they didn't go any lower, so we haven't gotten around to put more money in. SKT, I like them, but little dicey right now with those guys. SunPower, one of our favorites. See, you can see the big, when you see a big imbalance like that, it means that we really like them, obviously. Target, oh God, another one, ridiculously undervalued. So Target's another good one. We got a spread on those guys. And Williams-Sonoma, that's another high end servicing the top 10%. Because, you know, in inflation, and again, it goes back to, you know, when you're in Best Buy, okay, and somebody's looking at not an espresso, what's the other thing that makes coffee? Keurig. Someone's looking at a Keurig, and it was $100, and now it's $110 or $120, and they're like, I can't believe this is $120, blah, blah, blah. Meanwhile, you're in Williams-Sonoma, and they've got this DeLonghi $500 espresso maker, and now it was $4.95, and now it's $5.95. That person doesn't even know what it was. They don't even care. They're like, oh, $5.95, sure. It's a whole different crowd, whole different concept. You know, you're in Williams Sonoma, there's like $20 bags of pancake batter. I look at that and I'm like, I'm sorry, but that's not the price of pancake batter. It's like, I don't care how good it is, that is not worth it. Crate mix, I'll buy, but not pancake mix. But but so I'll look at that and be like, I know I could go to like, I know I can go to a local store and get it for like half that price. That's ridiculous. But then I watch people just pick them up off the shelves while they're there buying their $600 a longie. They're gonna buy they're gonna pick up a bunch. They'll buy pasta. That's another thing that drives me crazy at that store. They buy the pasta, and I'm like, are you freaking kidding me? It's crazy what people will pay prices for when you could just, I mean, just you must have passed 5 different stores on the way to Williams Sonoma that sell these things for half as much money. And it's the same thing. The same freaking brand is available at the supermarket. But it's not. It's just too much bother. It's like, well, while I'm here, I'll pick up some stuff from the that I would buy for groceries. That's why they sell it, right? I mean, people. It's impulse items for people who shop there. So anyway, so that's a great little profitable business, and they went on sale. And here we spent, look, 39 minus 18 is 20, minus 8 is 10, 12, 13, about $13,000, and it's a $50,000 spread. And we have the 100, 150 spread with the 100 put. So as long as they don't go down, we're going to make money. And if they get to 50, we're going to make a considerable amount of money, $35,000. And again, it's an early entry spread. We're very happy to buy more and commit to more of this stuff. All right, so Jesus Christ, 240 already. How's the market doing? Oh my God, nothing. Nothing. See, I never put Yeti there. So weird. That should be the down. How does it get there? So right now the dollar, see the dollar at 105? That's getting pretty strong for the dollar. That's pushing a lot of other things down. See how oil is practically reciprocal to the dollar? Dollar went up, oil went down, gasoline went down, because you buy these things for dollars. So when the dollar gets stronger, these get weaker. But oil also had a bad report today. Ooh, that's a good idea. Let's take a look at that. Here we go. Petroleum status report. We didn't get one last week. They skipped last week's report completely. This one says June 24th, so that's this weekend. Yeah, I'm only going to annoy myself looking at this and think of it. Imports 6 million barrels per day. Over the past weeks, crude oil imports averaged 6.3 million a week, blah, 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 blah. Okay. Commercial crude inventories decreased by 2.8 million barrels, but gasoline went up 2.6, so those two wipe each other out, and distillates increased by 2.6. So there's a net build of 2.6 million barrels. Now, that's because we took how many barrels out of the SPR? 408 to, I call that 5 to 8 is 7. 1 million barrels a day. Duh. Math. 1 million barrels a day was moved from the SPR into the market, and that caused this build. Okay, otherwise we would have had a 5 million or about a 5 million barrel draw. But back to the thing that always drives me nuts: we are exporting 4 million barrels a day out of the country. That's insane. And that's so all the oil we import, we are exporting, and we are exporting 4 million barrels a day out of the country. And that is just wacko cuckoo thing that we're doing. And you have to put that in context. I mean, that's per day. And we only use 19 million barrels a day total. So it's 20% of our total oil is being brought in for export, and that's what's boosting prices, and that's what makes That's what makes consumption. See, then they call it, even the EIA, who's got the data right there, they call this US consumption. They tell you how we're consuming. They tell you our refineries are at 95% of their capacity. But they're at 95% capacity because 20% of what they're doing is being done for other people. But that's why the refiners are making a freaking fortune. And that's why Joe Biden is starting to complain about this stuff and finally catching on. But like, here's Valero. And then you got like Sunoco. You know, they're having a great time. And it's very annoying. But anyway, so the bottom line is, you know, we're not really consuming this oil that they say when they talk about consumption being up and American consumption coming back. It's not true. We opened a side business selling oil to other countries that didn't exist before, or was half last year. Last year was 2.7. But even that, last year, we shouldn't have been doing it. The whole thing started because there used to be restrictions on how much oil could be sent out of the country. Trump removed the restrictions, which now allows the oil people to manipulate the market by sending the oil out of America and creating an artificial shortage in this country. That's what the law was designed to prevent. We're using now, and also oil's a scarce resource. It's a finite, scarce resource that we have in America, and we're squandering it, selling it to other countries for a short-term profit. It's wrong on so many freaking levels. Not to mention, it's the key driver of inflation. You know, we don't have. There's no reason for it. We're exporting the oil and creating an inflationary cycle that everybody's freaking out about and causing a recession that the market's freaking out about. And it could all be fixed by this one thing: stop exporting all this freaking oil. I think I'm gonna write an article about it this weekend. I'm getting kind of tired of it. But anyway, that's where we are. So, what else should we look at? Any questions? No questions? You have that cell link to Red 1, Dave says. What does that even? Oh, I see that thing. Symbol link, unlink. Oh, if I do that, it's not going to happen anymore? Oh, dude, thank you. Thanks, Dave. That's what it is. I don't know what Red 1 is, but I mean, that's interesting. None of my other cells have that. Okay. I don't know. I don't know what Red 1 is or where it came from, but apparently. Oh, look, it's this. It's if I look it up. If I look up the option chain, it made it on the chart. Now I get it. This is a Red 1. And that means that if I put something in here, it was going in there. Oh. Oh, I see. And when I put YM in here, it caused it to come out there. Oh, this is so weird. Thank you. Ah, I now understand the whole thing. Oh, that's great. I feel so good. All right. Anyway, dollar. Wow, dude, thank you. That's been bothering me for like a year. So currencies, dollar, right? Yes. So the dollar has been going up a lot since April, and that's been putting pressure on the market the whole time. But the pressure peaked out in May, and now we're only coming back to where we were in mid-May. But the dollar up in April, that's the key thing to look at. And then you look at the indexes, and what happened to the indexes? Down into mid-May, right? And now we're back to mid-May. So really, we're just being repriced against the dollar. That's what's happening here. Then there's a double effect on the bigger companies like the S&P and whatever. The more money you make overseas. Okay, this is, and again, these are things that are not terrible if there's no inflation, but when there is inflation, it's a huge problem because you set prices, right? Like you're selling Toyotas for I don't know, you're selling a Toyota for 50,000 euros, right? Okay, so 50,000 euros, and let's look over here. So 50,000 euros at $1.12. So 50,000 bucks times 1.12 to the dollar is $56,000 for your Toyota, right? So the company sends the Toyota over and prices it $56,000, whatever. So then now it went, you ship the car, it sat on the lot, blah, blah, blah. Now you sell it for 50,000 euros, but you're only getting back 1.05, 52.5. That's a big freaking difference. That's $3,500 less than you were supposed to get for the thing you sold. All right, you're getting close to a 10% differential. This is drastically impacting, currency exchange issues are drastically impacting corporate earnings. That's one of the reasons Goldman said don't expect corporate earnings to be that good this quarter, because when did this happen? It happened in Q2. All right, so Q2 starts the end of March, and look what happened. The end of March to here is whatever number that is, like 7% or whatever the drop is. So basically, it's like a 7% drop in the revenues received, and the drop has been for the last 2 months of Q2. So 2/3 of Q2, and actually a big chunk of April too. You've had a very serious decline in currency exchanges. So let's say it averages 5%, right? So in anything you sold in Q1 in Europe, you got 5% less dollars for the same thing in Q2. So unless you were able to immediately get your prices raised by 5%, you're going to take a hit to your revenues, and so you're going to take a hit on the revenues received, you're going to take a hit on your profits, and it could be a big hit on your profits, because 5% could be all your profits, right? So you're going to take a big hit on revenues received and a big hit on profits coming back in for corporations. That's bad. At the same time, you've got costs inflating on stuff coming in, plus your fuel charges. This is how you know if you're going to have a good earnings season or not. You just pay attention. It's not a freaking mystery. This is why it drives me nuts that's why I call them economorons, right? It drives me nuts when people say, oh, who could have predicted this? It's like it's written right there. What happened in Q2? Well, the money collected, if you're a company that does a lot of business overseas, you took a 5% hit to your revenues and earnings, right? Number one. Number two, if you're a company doing business overseas, your average cost of fuel in Q2 was basically 109, right? Your average cost of fuel in Q1, which ends on March 31st, is, see, it started at 70. You had the spike though. So let's say it's here, it's 90. So it's 109 now, it was 90. So your average cost of fuel is 20% higher. So it's not that hard for me to figure out other things being fairly similar. And there's, of course, other factors. You've got supply chain, you got this and that, whatever. But on the basics, you can calculate how hard it's been, what kind of environment has this been for companies, and it has not been a good environment in Q2. But that means also that when we see a company getting killed for things that are obvious, we have to think of that as an opportunity. We have to look at that and say, here's a chance for us to get in, because we know why they took a hit. They didn't take a hit. Again, going back to like Best Buy or Crocs or whatever, they didn't take a hit. Even Nike, who just had a problem with their earnings, they didn't take a hit because they're a bad company. They didn't take a hit because their operations are bad. They didn't take a hit because their demand is off. They took a hit because the dollar fluctuated, and because the euro fluctuated, and because oil fluctuated, which they had no control over. It has nothing to do with them. So why should I make that drive my investment decision? Will high oil persist? Will the strong dollar persist? And do they have the pricing power to adapt? They have market share and so on, and pricing power to adapt. And if they do, and if they can weather the storm, then as a long-term investor, this is my opportunity to buy somebody when they're cheap. And that's the kind of stuff that we've been adding to our long-term portfolio. And that's the kind of stuff that we're looking for to add more things. And like I said, we bulked up our hedges now in the short-term portfolio. We added $800,000 of additional hedging in the short-term portfolio. And we're pretty balanced because we've got 1.5 here. Remember, 3 million is like the magic number. So we're 1.5 here. And in the short-term portfolio, we're at 1.45. So we're at 295. So basically, we're just a shade under 3 million, which was the best we did. I think 3.1 or whatever was the best we hit as a combined total. So we're right about at our peak of total power, although it's flipped very much. Okay, it was before the long-term portfolio was 2.5 and the short-term portfolio was 500. Now the two portfolios are about even. I don't really care though. The money is shifted, but they're both very much in cash. There's 1.4 million in the long and 1.2 million in the short. So we have a ton of buying power to adjust. And so our job is to take the opportunities. Our job is to figure out where to move that money and how to take the advantage of each situation as it comes up on the long side or the short side. All right, so that's what we're doing now, and that's what we're going to be doing for the next week or so. We're going to be looking for more longs now because we added 800,000 more hedging to the short-term portfolio. And I feel confident enough to now put more money into longs. And what's the logic? Because if the long-term portfolio, as long as the short-term portfolio is catching up, all that's going to happen is we're going to have more and more and more cash in the short-term portfolio, right? Because we'll cash in these as they pay off. So we'll have more cash in the short-term portfolio, and the long-term portfolio might lose value. But like I said, I'm happy to double down on those stocks. So think about it. If this doubles in value, let's say the market drops 50% from here, and the long-term portfolio goes from 1.4 million to 700,000. Okay, this portfolio will go from 1.2 to 2.5. We'll probably at the moment we'll probably do actually better than we would otherwise. Than if the market just goes up. I mean, for a moment, but then we won't need much because to double the long-term portfolio, if it drops to 700,000, we only need to add 700,000. That would leave us with 1.8 million in this portfolio. Then we'd have 1.8 million in the short-term portfolio and 1.4 million in the long-term portfolio, which is still the same 3 million total dollars. But then when the long-term portfolio comes back, if it comes back to where it was, it'll be at $3 million by itself, and the short-term portfolio, let's say it goes to 500,000, we'll still be at then we'll be at 3.5, better off than we ever were. And but it's a balancing act, okay? We balance one side and then the other side, and we try to make a little improvement each time. And if we can just squeak out those little improvements, since the little improvements are like 50,000 bucks in a clip, if we can squeak out a little improvement here and a little improvement there, we drive the portfolio forward, even in a crappy market like this. And that is really the key to the whole thing. If you can make money in a choppy, crappy market like this, then everything else will take care of itself and we'll do really well. All right, so thanks for listening, everybody. I appreciate it. Everybody, why can you people not ask questions before we're done? SK says, just join the call. Everybody seems to think it's going down a lot more. What's your expectation of the S&P? I think we're flatlining from here. I expect nothing. And what he says, what between SQQ and TZA hedges, what percent should be in each? It's not a percent so much as it is, the value changes. You've got to play with it and balance it out so that you're comfortable that, if the market goes down a few percent, your short-term portfolio loss gains should cover your long-term losses more or less. Once you get it balanced, then you can play with it. But the trick is, really what you want to do is just work on the balance at first and make sure you understand what you're doing. And I'm really happy to talk about that in chat as far as what the balancing things are. But it's not that complicated, really. I mean, we primarily have now 30-60 spreads. Oh, I'm sorry, not 30-60, 30-70 and 30-80. So we have $40 of headroom on these. So 40 times 800 is $3.2 million. Is that right? Wow, that's crazy. Yeah. So it's 40 times 800. Yeah, 3.2 million. Seems like a lot, right? So we have $3.2 million between 30 and 70. So if we hit 70, which I don't think we will, but if we hit 70 on SQQQ, then we have 3.2 million of in the money $30 calls. We will then have to start paying back these guys, and that becomes a bit of a problem. But again, my bet is that this isn't going to happen. And in 2023, we have the 70s. So as long as these 70s expire, these are the undercovereds. As long as these 70s expire worthless, then we are going to then have $3.2 million of coverage just through the SQQQs. Now, the net cost of this coverage at the moment, it's 2 million minus 1.4 minus 9 is 2.4. Minus 2 is 2.6, 2.8, whatever. And here's 2.8. So the net cost of this entire spread is about $0. But you have to understand that we are taking a risk that if the NASDAQ, if SQQQ goes over 70, and that would be 14 divided by 56 is 25%. So basically, if the NASDAQ falls 8% more than it is now, then the SQQ will go up to 70, and then we're going to be in trouble. At that point, we start to be in trouble because we don't have a coverage for that. Okay. We had picked up the 60, 80s, but then we rolled the 60s down. Then we rolled a lot of the 60s down to the 30s. So we changed the nature of our coverage, but that's why we have 3.2 million now in coverage there. Anyway, it's all about finding a comfortable level of balance. But so the bet we have right now is that we think the NASDAQ, we think the NASDAQ is not going to fall more than 8%. 8% is not that far. That's going to be, well, where are we now? We're at 117. So 11700 times 0.92, 10,700. So right here. That's effectively what our bet is. Our bet is that 10.7 is going to hold through the end of the year. And I think we should settle down around 12,000. That's what I expect to happen over the course of the year. If we're right, we're going to make unbelievable amounts of money. If we're wrong, we're going to have to adjust. But it's very important at all times that you understand exactly what your hedges are doing and how they pay off and where they pay off and what they're supposed to do. Because if you just let that slide and you don't adjust, you can get really killed by that stuff. Now, realistically, like I said, we have 350 undercovered NASDAQ short calls at 70. So we're going to make $3.2 million at 70. So at what point do we lose $3.2 million? Well, it would have to be $100 out of the money. So we have a long way to go before 350 calls are going to wipe out our gains. But if they do, obviously, our hedges become worthless and we're totally screwed. So we don't allow that to happen. We take the cash and we cover, or we buy back the short calls that we were wrong about or whatever, and we'll have less cash, but then we'll still have our $3.2 million if the market keeps going up. So in other words, right now, our undercovered, okay, we have 1,000 longs and we have 1,100 and wait a minute. We have 1,100 plus 350. So we have 1,450 short. So we have 450 undercovereds. So 450 undercovereds times 50,000 would be $2.2 million. So if at $120, we'll still net $1 million out of this spread. Don't forget, this is only a net zero spread. So at $120 on SQQQ, if it more than doubles from here, we'll net back $1.2 million. So that's why I don't think it's that risky to cover it that way. But of course, we're counting on having a lot more money than that. We're at 1.2 million now in cash and 1.4 million value in the portfolio. So if all we end up with is having $1.2 million, our hedges didn't do their job and the long-term portfolio would be much, much lower, et cetera, et cetera. So what do we do to prevent that? Well, if we start getting nervous, we can either add more longs, but those longs are pretty freaking expensive, or we buy back some shorts. How much does it cost to buy back 350 shorts? Okay, cost us $266 plus $199, 500, a bit less than $500,000. So we will take $500,000 of our cash, buy these back, but then we've got $3.2 million of cash that we can generate on the hedges, which would bring us to $4 million, and then I feel good about the hedge. So, you know, we can't let it run because the possibility of getting burned can ruin our entire strategy. So you can't just let it run forever. We have to start buying them back if we think we're in danger. But if we're playing it correctly, we're going to make incredible amounts of money. But you can't, you know, it's like it's a little like tightrope walking, right? You can go a little, you can lean a little to the left, a little to the right, but you can't lean too far or you are going to fall off the freaking thing and crash. And you've got to know how much you can lean. The difference between a professional tightrope walker and a person who falls off the rope is knowing how far you can go before you have to pull it back in. So you've got to balance it, and you've got to monitor it, and you've got to completely understand the parameters of your head. If you don't do that, and again, this is advanced. I don't recommend this I don't recommend, you know, being too far, too extended if you don't have complete control, if you don't really understand your hedges well. But for practice, a little bit of unbalance is a great thing. This is a lot. This is right now a fairly large amount of unbalance. Just circumstantially, this is how we ended up based on the opportunities that were presenting themselves. But I would not let this ride. I don't have a very big tolerance for this. The reason we have all this cash is because we let things ride. Okay, so we let things ride. And so far, so good. So far, we're threading the needle. If the needle looks like we're not going to be able to thread it, we immediately buy this back. Our dreams of making ridiculous amounts of money disappear, and we hope to make sensible amounts of money instead. But I'll take it. Sensible amounts of money is fine, especially in a down market, because it means we can take our sensible money from the short-term portfolio and use it to buy a ton of cool stuff in the long-term portfolio. Fortunately, at the moment, we don't need it. We've got 1.4 million. That's another reason we get to play in the short-term portfolio, because the long-term portfolio still has 1.4 million in cash. So we don't need the short-term portfolio's money at all. We're not even projecting that we're going to need it in the near future. As long as we don't need that money, it means that we're allowed to play with a little bit and take a couple of risks. But you've got to, you have to understand your risk parameters 100%. Like tightrope walking, IndyCar driving, whatever, you've got to know your balances and you've got to know the limits of your machine. Otherwise, you will crash. So that's the key, and something you have to work on. I'm sorry, there's no magic number that's going to tell you what it is, but you've got to figure out the right balance for your portfolio. We've been adding and subtracting and shifting and moving for 2 years to get to where we are now. 2 years of moving around these positions to finally get to this balance. And what we did, the reason we have the extra short calls is because we cashed in some long calls. That's where this cash came from. We were down to like $500,000 in cash. We cashed in some long calls, but that left us exposed on short calls that are uncovered. So what do we have to do? We have to go back now and we have to either add more long calls, but that's expensive, adding more long calls, or buy back the short calls, less expensive. And frankly, the other day, the other day was like yesterday. I mean, yeah, look how fast we came down. I mean, the other day I was about to make I was going to tomorrow, not yesterday. Yesterday was Tuesday. So on Monday, let's see if we can get to an hourly chart. Okay, so we had the rally on Friday, right? And on Monday, I was thinking, you know what, we should probably cash in, pull. We should probably buy back some of those short NASDAQ calls. Oh, here's a NASDAQ, so do it on that. So I was thinking here on Monday morning that we should probably buy back some of those NASDAQ calls because we got this gift because we had cashed out our longs here, and then we got a 1,000-point rally or whatever 500-point rally, and I was like, that's really nice. So we got a good cheap price to buy back on. We should probably do that. But I was greedy. I said, okay, let's wait till tomorrow and pull the trigger. Then we dropped, and then we had the mega drop, and that was it. Then the whole plan went out the window. So now I'm hoping, which is not a good investing strategy, but I'm hoping we come back and I won't be so stupid next time, and I'll use that to buy back the short calls. But if things get worse, then we're going to buy back the short calls anyway because I can't risk it. I would much rather buy them back for instead of buying back for 500,000, I'd love to buy them back for 400,000. That's where we are right now. But if I have to buy them back for 500,000, that's what we're going to do. We're not going to risk this going back to here, because then we're at 70 and then we're like freaking out because our whole hedge could unravel if everything's back at 70 on the SQQQ. All right, so on that happy note, that's where we are, and hopefully things go well next week. All right, so we'll do this all again next week. How much hedge do you have in TZA? Dude, it's like right here. It's on the portfolio. Okay. Okay. So, but that's, again, keep in mind, that's against a very large, an equally large 1.4 million portfolio. Currently, though, we are hedged. Well, like I said, we're weirdly hedged that if the NASDAQ drops 8% more exactly and stays there and holds that level for the next year, that's what we want. That would be the ultimately great outcome because it would give us so much cash, unbelievable amounts of cash in the short-term portfolio to then buy double the amount of long-term portfolio positions and still have plenty of hedges left over in the short-term portfolio. That would be the ultimately great thing, is if the market drifts around this level or goes a bit lower and we're able to cash out. But when does perfect ever happen? So we'll see what happens. That's why we do this every week, right? All right, thanks for coming, everybody. Take care. We'll do it again, and we will do. Oh, next, don't forget it's a holiday. We have 4th of July, so happy holiday, happy 4th, and we'll have a webinar next week. There's no reason not to. All right, take care, guys.